But I would say longer term, I think we've been, there's a significant regime shift in the markets. So something we've not seen for quite a long time. And they say markets climb a wall of worry. Well, it's true that there are enormous number of things to worry about at the moment. And on the inflation side, all of the kind of tailwinds that equities have had in terms of easing monetary policy, every time there was any weakness, the banks would increase their easing. You've had governments running enormous fiscal deficits, so tremendous support on the fiscal side. And then you've had generally quite low commodity prices, which have been supportive for growth. What you're seeing going forward is all of those issues reverse. So you're seeing central banks now very focused on their inflation mandate. They've underestimated the stickiness of inflation. They feel that they're really in the wrong place and they need to move quickly. So the Fed, you've seen becoming really surprisingly hawkish. Even with the war breaking out in Europe, that did not change their forecast in terms of what they were going to do with interest rates, which is a really surprising change. You normally expect a market shock, they immediately switch to an easing bias, but that's not happening this time around. You then have the fiscal side where you just automatically, as governments normalize their fiscal spending post-COVID, you're going to see those deficits shrink, which again is difficult for growth. And then you've got obviously now concerns around supply of commodities and energy prices going up. So significant risk factors and potential headwinds for equities. But again, if you're a longer term investor, and you can't just sit in cash when inflation is eating away the purchasing power of your savings, people need exposure to some of those risk assets. But what we're saying is that you have these very wide range of scenarios with major risks. So having some protection for both sides, for the extreme positive environments and those extreme negative shocks, makes sense in a balanced portfolio. The part of the we're seeing a lot of institutional investors, as we discussed, questioning some of that bond allocation and looking to maybe split that between taking more exposure on the equity side, where they have higher return expectations, but combining that also with some explicitly defensive strategies to manage those drawdown risks in the portfolio. So we don't take a macro view in terms of trying to pick a specific region to apply protection. So our role is to apply that consistent protection for a diversified portfolio of global equities. And we need to have that consistent return profile so that investors can understand how it's going to behave and use it as a reliable tool. But in terms of identifying where some of the big risks lie, then Europe has to be at the focus in terms of you have obviously a war with Russia invading Ukraine. You have some vulnerabilities in terms of commodity supply to Europe. And then perhaps in the medium term, what is more significant is if we are in this period of rising inflation, we've had a long period of calm where the ECB has essentially been supporting, backstopping all of the financing needs of the Eurozone member states. As they decide they need to pull back because of the inflationary pressures, then that's going to put some pressure on some of those spreads between the core and the periphery of the Eurozone. And if you start to see that fragmentation again of the Eurozone financial markets, then that's going to be potentially a very difficult situation for the markets to deal with. Well, you're seeing, so the US is obviously ahead of Europe and Japan in terms of the inflation cycle, so the central bank there is already starting to pricing in quite significant increases. It's going to be interesting if you start to see Europe move as well, then those German bonds will, having been in negative territory, will start to see a positive yield. And then the question becomes, how do states that have, Germany's in a very good fiscal position, but states that have very much weaker fiscal position, like Italy as an example, if they need to finance themselves at a significantly higher interest rate and they can't get liquidity from the European Central Bank, then they're going to have to potentially embark on some real fiscal tightening. So the government's going to have to really try and rein in their spending, and in terms of the economy, going back to that austerity, it's going to be potentially very negative.